What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown. Increasingly today, it seems like central bank digital currencies are inevitable. We've got pilot programs with them all over the world. We've got places like the WEF, the World Economic Forum, the IMF, Klaus Schwab. We've even got Jerome Powell recently saying that it's not about doing it first, it's about doing it well. Now, to be fair, there are a lot of advantages to central bank digital currencies, CBDCs. But as with anything, the devil is in the details, and it's not a question of whether a CBDC is good or bad. The real question is, who are they good for and who are they bad for? Because when you boil it down, the truth of the matter is that a CBDC, a central bank digital currency, is simply just a magnification. It amplifies everything that is wonderful about fiat currency for governments, and it magnifies everything that is terrible about fiat currency for the individual. Now, in order to understand why, we need to take a little bit of a trip back in time and look at the origin story of money itself and witness its evolution to the point where we are at today. Ready? Let's dive in. It is time for a little story, animated, of course, by my always legendary artistic skills. In the beginning, God created the heavens and the earth. Nah, I'm just playing. We're not going back that far. In the beginning, in the early monetary systems, money was non-elastic. This meant that borrowing and investing came from savings only. The supply of money was fixed, and the only way to get your hands on more money was to either work for it, sell something, or actually go and use labor and capital to dig it out of the ground. Therefore, for most of human history, the total supply of money did not actually change that much. In fact, it grew about on pace with the growth of the human population over history. Now, we know that the relationship between money and stuff, and when I say stuff, I just mean the economy. I mean all goods, services, assets, everything. So we know that the relationship between money and stuff is one of relative value. And that simply means that the value of all of the money equals the value of all of the stuff. So if the amount of money throughout most of human history didn't change, was growth even possible? Did we ever have growth throughout human history? Well, obviously yes, but it just shows up differently than what we're accustomed to today. Back then, growth showed up through price decreases, not price increases. And here's how that works. If the amount of money in the system doesn't change, but the amount of stuff in the system does change, the amount of stuff grows, that means all of the individual things can be now purchased with less money than it took before. Because before all that new stuff was created, you had the value of all the money equaling the value of all the stuff. That means if you wanted to purchase all the stuff, it would cost you all the money. But now you've created more stuff, and you still need all the money to buy all the stuff. That means if you only want to buy the amount of stuff that there was before the new stuff was created, you need less than all of the money. This is the mechanism by which throughout history, the prices of everything continuously went down. Said another way, for most of human history, we've been getting more and more for less and less. Said yet another way, the value of money would constantly increase over time. People got rich by saving as life got cheaper as time went on. In this system, debt is punished because it's harder to get your hands on more money over time as opposed to easier to get your hands on more money over time, because the same amount of money would be representing a constantly increasing pool of wealth over time. So this is how the world has existed for most of human history. That is, until one day you have a dishonest banker get a fancy idea. You see, around this time, people had stopped carrying around their gold and silver for purchases because, quite honestly, it was just a little bit too inconvenient. It was far more convenient to leave your gold and silver with a banker and let them store it for you, of course, for a nominal fee. Now, when your banker was storing your gold and silver for you, you'd have some certificates that would say, hey, if I come back and give them my certificate, I'll be able to get my gold and silver back. Now, for a while, people would use these certificates. Then they would go, whenever they wanted to make a purchase, they'd go get their gold and silver. They'd redeem their certificates for their gold and silver. They'd take that gold and silver, make the large purchase, and then whoever they purchased from, I'd walk away with my stuff. He'd now have the gold and silver that used to be mine. He would go back to the banker and he would deposit and get a certificate instead. Well, pretty soon people realized, hey, these certificates, they're as good as gold, right? Anybody can redeem them. So what I'm going to do is, instead of going through all of that rigmarole, that long process, I already have the certificate. I know I can redeem it for gold and silver. I'm just going to use that and pay for my goods and services with that certificate, and then if they want, they can go redeem for gold and silver with that certificate, and I still get my goods and services either way. Now, after a while of this going on, the banker looked around and realized there's very little chance that at any given time everybody's going to come and demand to redeem their certificates, and everybody who's going to want their gold and silver all at once. So he got a sneaky idea in his head. He took some of the gold that was on deposit and redeemable on demand. He took some of that gold and he lent it out for an interest rate, a small interest rate, a nominal fee. Basically, he's double dipping here. Now, just to be clear, this is categorically different than the way lending happened prior to the invention of this, which is called fractional reserve banking. Before, if you wanted to borrow money, you had to borrow money from somebody who had it. I'm going to borrow your gold from you. With this sort of lending, you're actually lending money into existence because that gold coin that the banker decided to lend out was actually already in circulation, being represented by the certificate that was in circulation. So now you've got the same gold coin that's actually doubled in circulation. It's in circulation twice because it's in circulation once from being lent out and another time from the paper certificate that could allegedly be redeemed at any time for that same gold coin. So you've got the same gold coin circulating twice. Now, you repeat this process enough, you have a substantial increase in the total supply of money in an economy. Now, in opposition to history up until that point, this now reverses the process or reverses the relationship that money has had with stuff. Because for most of human history, the supply of money stays the same and you have an increase in the growth of stuff, which means money goes further, money gets more valuable over time, and stuff gets cheaper. But now, as the supply of money starts to grow, now you have price declines happening more slowly. And eventually, price declines stop happening. Prices become stable. And then eventually, prices actually start going up. Because all the money has to equal all of the stuff. And so you have an increase in the amount of money that is equal to the value of all of the stuff. That means now it takes more dollars, more money, to buy the same amount of stuff as it did before. Now, as prices start to rise in this local economy, you start to see a fake wealth effect occur. Some people start to get fooled by a rise in prices in certain commodities or goods or assets or stuff. Some people actually think that they are getting rich from this, and since some people are getting rich, that causes a positive feedback loop where other people start to buy that same stuff because they want to get rich as well. And as all this new money starts pouring into this area, you start to have a bubble or a boom occur. Well, at some point, there's not enough new money being created in order to continue to keep the price increasing, and so at some point, the price stops increasing, and when that happens, people start to sell. You're no longer making money on it. When everybody starts to sell instead of buying now, that drives the price right back down to where it was before. Now people have to rely on savings, which means that withdrawals and redemptions start to happen again. And when redemptions start to happen again, that means loans are called in order to meet those redemptions. And when loans are called, assets and goods and products, they have to be sold in order to liquidate and get the amount of liquidity that you need in order to pay back what's owed. This is called a bust, and fast ones are called crashes, and big ones are called recessions, and biggest ones are called depressions. As you can see, booms and busts and bubbles and depressions, they're not a result of free markets, but a result of fractional reserve banking. They're caused by fraudulent money creation. And when these dynamics are severe enough, a bank run can occur because people look around and realize, hey, that bank lent out a bunch of money. They lent out more than they could have if they were just lending their own money. They probably lent out my money, which means they probably lent out other people's money as well, which means that if I don't go get my money right now, they might shut down. They might go bankrupt and I won't get any of my money. So I better go get my money before everybody else does. Now, you'd think this process would be outlawed. It's fraudulent. It's promising to redeem money on demand at any time while simultaneously locking it up in a loan that cannot be called on demand or at any time. It's artificially increasing the supply of money in a system. The direct results are booms and then busts. But instead of this practice being outlawed, this practice got nationalized. Instead of saying that banks have to honor their contracts, we created a bank for banks, also known as a central bank. Now these banks, the central banks, they would operate in the exact same way as the regular banks did. But as a regular bank held deposits and loaned money to individuals and businesses, the central bank would instead just operate to the other banks. This way, if a single bank was facing failure, facing a bank run, facing trouble, instead of that bank collapsing, they could just rely on the central bank, and the central bank would infuse that bank with new reserves that were transferred from all of the other banks. Now, obviously, this solved the problem of local bank runs and local bank failures, but you can't eliminate risk. You can only transfer it. And so when you centralize something, there was decentralized risk. Now you're centralizing it. You're just distributing that risk and transferring it to the entire system instead of allowing it to be isolated and take out individual banks. It puts the entire system at risk. Now, this is evidenced by the fact that the central bank in the United States, the Federal Reserve, was started in 1913 and only took 7 years until the first Great Depression happened, which was in 1920 and 1921. You probably don't know about it. Read Jim Grant's book. And it was called the Great Depression until only 9 years later when another depression happened that was even worse than that one, both taking place arguably as a result of central banking. Now, this is where things get interesting, because if this had happened in a completely free market, that would have been the nail in the coffin. It would have ended there. But bad practices that are ineffective and destructive can only persist via a monopoly on violence. And that is exactly the threat that the United States government used in order to get out of its problem then. By threat of imprisonment, through a monopoly on violence, FDR confiscated the gold of American citizens. Then he repriced it, raising the price of gold, which refilled the United States government coffers again. Now, this was a band-aid, but not a permanent solution, as we can see if we continue to look through history. Because we used that reinfusement of wealth by declaration to become the bank to the rest of the world. Again, scaling up instead of scaling down, centralizing global finances. We were once decentralized through banks, we centralized under the Federal Reserve, and now the entire world was centralized through Bretton Woods, starting in 1944 under the Federal Reserve acting as the central bank to the rest of the central banks around the world. To be frank, we pulled the rest of the world into the same scam, the age-old scam that the original bankers had, saying, hey, give us your gold, we'll give you some paper, and you can give us back that paper any time and we'll give you the gold back. Trust us. We got you. It's just far more convenient for you to use our paper instead. And the rest of the world happily agreed. Now, as was inevitable, the temptation to create more paper than there was actual gold to be redeemed for was far too strong to resist, and the United States continued to print more and more and more. And when the rest of the world realized, hey, there's a lot more paper out here than we think could actually be redeemed, it sparked another run on the bank, just like it always does. All of the rest of the world started to redeem their dollars for gold because they knew, hey, there's just not enough for us all to get it back, so we want to be the first ones. Well, the United States was about 2 weeks away from fully running out of its gold reserves, and just like FDR did to the American citizens, Nixon did to the rest of the world and said, we are no longer going to give this gold out, even though it technically belongs to you, therefore confiscating the gold of the rest of the world. Again, only possible through a monopoly on violence, which in this case looked like a military upper hand. We then entered the age of fiat. The creation of money was limited only by arcane laws that were in place from a bygone era when there was something of actual physical restraint on money creation. These laws kept in place to maintain the illusion that there's something to back up our money. And since 1971, we've seen exactly what one would expect under a system like this. We've seen extreme episodes and many episodes of hyperinflation and consistent and persistent high inflation globally. Again, the relationship between money and stuff is one of relative value, meaning that all of the money equals all of the stuff, meaning when you drastically increase the amount of money there is, the value of each of those individual units of money will be less than it was before. All of the money that existed before we created all the new money, before it equaled all of the stuff that there was. Now that there's a lot more money in the system, it still equals all of the stuff. Therefore, if you want to purchase all of the stuff, it takes a lot more money now. And if you want to purchase some of the stuff, it takes more money than it did before you created all the new money. Simply, prices have gone up dramatically. And as you might have noticed, we have a hodgepodge economic system that's built on multiple legacy layers that are tied to laws that were put in place from a bygone era that have absolutely nothing to do with the digital age. Banks still have to operate as if they're working with gold reserves that might need redemption at some point. And the central bank, at least in the United States, still can only act as a bank to other banks, as if there's actually some limitation on the amount of reserves that could be credited to a bank in a time of need. Now, we need to take a second look at debt here because this is a critical piece to the puzzle. We know in the old world, debt was punished. Now, debt is rewarded because it's easier and easier to get your hands on a higher number of dollars as time goes on because there's just more of them floating around. So the prices of things like labor and stuff goes up. Labor and assets and goods and services are just increasingly represented by a larger and larger supply of money. Which means that if you borrow today to make a purchase, you're actually purchasing that thing at a discount. Because when you finally repay the debt, you'll be repaying it with a smaller amount of real wealth. Corporations, governments, and even some rich individuals realized along the way that it was a quick path to wealth. But the problem is that leverage always increases risk. And just as in the small isolated incidences of bank runs and local booms and busts, we just have that on a much grander scale now. Bubbles are always the direct results of false wealth effects, caused by money flowing into where people think they are getting rich. And when the price increases stop, the money starts to flow out and the whole effect reverses itself and you end up with defaults and crashes. This means that for the time being while the crash is happening, the supply of money is actually decreasing as well. This means that debt becomes harder or more painful to pay back in crashes. This is obvious, right? If you owe 300 grand on your house, but now your house is only worth 200 grand, you're underwater. It's hard to pay that back. A lot harder than the opposite if it went up to 400 grand. And sometimes not harder, but impossible. So what do you think is going to happen when it's the government facing the abyss of default? When it's the government facing the pain of insolvency and not being able to pay back its debt? Especially when the government has the power of the printing press. Do you think they're gonna let default happen? Do you think they're gonna face insolvency by choice? I think probably not. But here's the problem. The United States government can't actually directly print. The United States government doesn't have that power. That's the Federal Reserve. And no, the Federal Reserve is not a 100% government entity. It's a quasi-private, quasi-public entity. Yes, like I mentioned before, we have a system built on arcane laws from a bygone era when people actually had to do work to get their hands on new money, even the government. The Federal Reserve is the one that can print the money. But guess what? They can't even directly hand this out to people. They can't even directly hand this money out to the government. The only thing the Federal Reserve can do with the money they create is give it to the banks that are under their umbrella. Now, the banks can take that money and they can then give that money to the government in the form of a loan. And the banks can take that money and give that money to individuals in the form of a loan. So this is what the banks do. The banks take this money that the Federal Reserve prints and gives to them, and they lend it out to people, and they lend it out to the United States government. But the appetite of the government is a little bit too high for what the banks by themselves can afford. And so the banks, what they'll do is they'll lend money to the government, but the government wants to borrow more money from the banks, so the banks turn around, they give that debt to the Federal Reserve in exchange for more money. They just sell that debt to the Federal Reserve. Now they're flush with cash, they can lend to the government again. So the banks are just operating like a middleman between the government and the Federal Reserve. Just like they're operating as a middleman between individuals and the Federal Reserve. The banks are just glorified middlemen at this point. And the banks can repeat this process as much as they want. There's no inherent limit on it because there's no possibility of bank runs because they can get all of the reserves that they need from the Federal Reserve that can print money. But individuals don't have the ability to continue increasing their borrowing, whereas the government does. This has gotten the government to a point where at certain points throughout history, its debt load, its debt burden has gotten a little bit too cumbersome. So what do you need to do if your debt burden gets too painful? Well, you need to get your hands on more income. Make it easier to pay that debt off. Well, in order to get more income, you just need to make money more easy to get. And in order to make money more easy to get, you need to increase prices. And if you want to increase prices, you just need to increase the total supply of money in the system. And if you want to increase the supply of money in the system, you can rely on individuals to borrow more, but that can only go so far because there's a limit. So the government would just need to spend more in order to spend money into the economy to grow the total supply of money. But the only way they can increase their spending is, wait for it, to increase their debt. Yes, the United States government must increase its debt amount in order to decrease its debt burden. Which is why you've seen over the past couple of decades, the total national debt has skyrocketed, but the cost of servicing their debt has actually gone down. All facilitated by central banks crediting reserves to regular banks. Now, if you weren't paying attention in Economics 101, you probably wouldn't realize that this is actually very painful for banks. Because as debt gets cheaper, as money gets easier, that means the people profiting off of those loans get squeezed. That means the banks, who exist only to make loans, make less and less money per dollar lent out. Said another way, interest rates go down. So before, if you were able to make 2 pennies on a dollar, now you can only make 1 penny on a dollar. But that means if you want to keep your same amount of revenue, you have to double the amount of debt. This becomes a problem in times of crashes and economic distress when banks who are faced with the concern of deflation, they're also looking and saying, hey, interest rates are going down, which means that not only am I worried about these loans that I currently have defaulting and not getting anything back, but I'm actively needing to try and increase the total amount of debt that we have outstanding just to keep pace with our current amount of revenue. And so to avoid going under, loans start being made to worse and worse borrowers because quite frankly, they're the only ones out there with an appetite to borrow, which means you'd expect in a situation like this to see a rise in zombie companies and the lowest interest rates in history for junk bonds. Oh, and look at that. That's exactly what we're seeing right now. Now, all of this could be avoided if we simply could just erase the ties to an arcane gold standard, right? Enter the central bank digital currency. You no longer need the banks. You no longer need the middlemen because quite frankly, they're worried about their own profitability, number one, and number two, they're not as effective at getting the money out where it needs to go in order to stop the crashes from happening that were the result of all the overprinting in the first place. And so why not just get rid of the middlemen? Instead of individuals and corporations having a bank account at banks and then those banks having an account at the Federal Reserve, at the central bank, why not just eliminate the middleman and everybody gets an account at the central bank? Instead of having to go through all of the legal loopholes and the special purpose vehicles housed at the Treasury, you could once and for all just meld fiscal and monetary policy. The people who spend the money and the people who create the money, the government and the central bank. You wouldn't need bank lending to increase in order to get the money where you needed it to go. You wouldn't need to rewrite the entire internal revenue code every time you get a new leader in there who wants to incentivize or disincentivize certain behaviors that they believe is going to be helpful for the economy. You just bring everything under one roof. You can streamline it. Operations become far cheaper, far more effective, and far more efficient. If you need to direct money to the unemployed, you can simply credit it to their account. And you know if they're unemployed because you can see everybody else's account and you can see that nobody is paying them for labor. And if you want to increase taxes on something like gasoline, you can just reprogram the money in real time so that anytime that money is spent on something like gasoline, there's an extra tax added to it. If you want to engineer social justice or equality, you can simply program certain dollars to expire if they're not spent on businesses that are owned by, let's say, people of color. If you want to stop the sales or the transactions of certain items like, certain types of weapons, you can simply program the transaction to not go through if those dollars are trying to be spent on something like that. If you want to catch a criminal, the central government has direct access to a fully detailed money trail of every citizen that person has ever interacted with financially. It'd be so great. Any person or any business could potentially be immediately locked out and prohibited from engaging in any financial transactions with anybody, simply with the click of a mouse. A CBDC puts the control of full economic and monetary direction in the hands of a few Ivy League kleptocrats. Put simply, it's a tyrant's wet dream. And here's the most important part. It's not a future possibility. It's being rolled out and tested all across the world right now. The only thing preventing this from full implementation in many countries is simply laws. Laws that were put in place in old monetary systems where the monetary system and banking was governed by physical restraints on something like gold or silver in order to prevent something just like this from happening. Now, you might be thinking, hey, they could use this for a lot of good. They could use this to get the money into the hands of the people who need it, and they wouldn't have to tax others in order to do that. If you want to give money to the poor, you can simply create that money out of thin air and give it directly to the poor. But we know the relationship between all the money and all the stuff. All the money equals all the stuff. So that means if you give people money, if you increase the amount of money, that means the cost of everything increases proportionately. And just like they've proven their capacity to do, if they give you $1,000 and stick $10,000 in their back pocket, that means you might have an increase of $1,000, but that means your cost of living is going to go up by $11,000. Are you really better off? Now, you might also be thinking that just because something has the potential to be used in a bad way doesn't mean it necessarily will be. And fair point. But absolute power corrupts absolutely, and CBDCs are essentially absolute monetary and economic control. And I would rather not live in a world where I must rely upon the kindness of monsters. If a system only works when the right person is in charge, it's a bad system. In the words of Naval Ravikant, the test of a good system is one that you design and then you can hand over to your enemies to run for 10 years and it still works. We saw localized booms and busts as soon as our monetary system transitioned from just stable money to fractional reserve banking. Then we saw global depressions when we centralized fractional reserve banking, and then we saw global wealth confiscation and consistent, persistent high inflation when we went from gold-backed central banks to pure fiat. The fact is, the broken system that we have right now is still imposing at least some constraints on spending and monetary creation. If you think the inflation and the bubbles and the depressions that we've seen over the last couple of decades are bad now, just wait until there are no constraints. The banking system as it exists today will not survive a transition to CBDCs by design. The intent is to remove them as a middleman. At that point, all of the control will be in the hands of the government. And if you don't have any of your wealth outside the financial system, gold, silver, Bitcoin, by the time that this takes place, it will probably then be too late. Now, we've run out of time for today, so there's a story for another time, but it's not like it's all doom and gloom. Systems like full-blown CBDC tyranny are destined for collapse. They cannot survive. And people who get their wealth outside of the system before it devolves into that become very wealthy in the process. If you'd like to see all my recommendations for buying gold, silver, Bitcoin in various forms through various accounts, see the links that I have in the description below. And as always, I really appreciate you guys. Thanks so much for watching. Have a great day.